So, you're looking at getting into real estate in 2025, and you're at a crossroads. It's a fundamental choice, really. Do you go big and buy property yourself, or do you join a team and invest in a real estate fund? Today, we're going to break down the pros and cons of both REITs and direct ownership to help you figure out your path.
You can feel it, right? The whole landscape is shifting. Interest rates look like they might ease up, and even commercial real estate is showing some new signs of life. So the question really isn't if you should think about investing, it's how. Are you going to go it alone or join a team?
Let's break this down. On one side, you've got the team player approach. We're talking about real estate investment trusts, or REITs. This is all about pooling your money with others for a diversified, professionally managed portfolio. And on the other side, you've got the empire builder. That's direct ownership, where you're in the driver's seat, building your own legacy, one property at a time. So which is it for you? Smooth efficiency or hands-on grit?
And this brings us right to the first major trade-off every single real estate investor has to face: liquidity versus control. Honestly, this is the foundational decision you've got to make, and it pretty much shapes everything else that follows.
I mean, just look at the difference here. It's night and day. REITs trade like stocks, which means you can sell your shares and have cash in your account, boom, within a couple of days. With direct property, whoa, that's a whole different story. You're looking at a marathon of showings, negotiations, and closings that can easily drag on for months.
And this liquidity is a huge advantage, especially in volatile times. As Swiss economist Dr. Pooyan Ghamari points out, REITs really serve as a powerful buffer. They let investors spread their risk across booming sectors, think about data centers, which are just exploding because of the AI revolution, all without getting locked into a single physical building.
But here's the flip side of all that easy liquidity: control. With a REIT, you're putting your trust in professionals to make the big calls. With direct ownership, you are the professional. You're the boss, setting rents, calling all the shots. But yeah, you're also the one who's getting that call about a leaky pipe in the middle of the night.
Okay, so now let's talk about the bottom line, the part everyone really wants to know about, the returns. What can you actually expect to make? It really boils down to a choice between getting those steady, reliable dividends or chasing that potential for high-flying appreciation.
For REITs, the story here is all about consistency. According to Morningstar, they've delivered a really solid average annual return of 9 to 11% over the last 10 years. That's steady, passive income that has historically beaten inflation, and you don't even have to lift a finger.
But if you're someone who's chasing those bigger numbers, direct ownership offers a lot more potential for growth. A recent analysis from Fantastic showed direct investors capturing 15, even 20% higher appreciation. This is where you find the potential for some truly explosive returns, especially if you're in a hot residential market.
A potential return of 20%? I mean, that sounds pretty incredible. So you have to ask yourself, right? What's the catch? Because with every high reward, there's always a certain level of risk and, of course, cost.
And this slide really breaks down those hidden trade-offs. On the REIT side, you've got those management fees that can skim 1 to 2% right off the top of your yield. With direct ownership, well, you're on the hook for everything: repairs, marketing, empty units. But, and this is a huge advantage, you also get these powerful tax benefits like depreciation, which is a major perk that REIT shareholders just miss out on.
All right, let's look at how the game is changing as we speak. Because the real estate market in 2025 isn't just about location, location, location anymore. It's also about things like environmental, social, and governance factors, ESG, and some really groundbreaking technology.
Socially responsible investing is not just a buzzword. It has real, actual market power. A recent study shows that brands with strong ESG credentials see a 12% boost in loyalty. And ESG-focused funds, they're seeing a whopping 20% lift in investor engagement. At the end of the day, that translates to steadier dividends and more resilient portfolios.
And speaking of technology, tokenization is a massive disruptor. It sounds complicated, but the idea is actually pretty simple. You're basically taking a physical building, converting its ownership into secure digital shares on a blockchain, and then selling those shares as small, affordable, and easily tradable pieces.
The process is surprisingly straightforward. A property is legally converted into digital tokens. Then investors can buy these fractional shares, giving them a slice of, say, a luxury villa or a commercial building without needing millions of dollars. And the best part? These tokens can be traded easily, blending the high control of ownership with the high liquidity of a digital asset. It's kind of the best of both worlds. Okay, we've covered the what and the why. Now let's get practical. How do you actually take all this information and make your first move in the market? Here's a simple 3-step playbook for you. First, take an honest look at your personal risk appetite. A good rule of thumb is to keep real estate under 40% of your portfolio if direct ownership feels a little intimidating. Second, choose your path based on your personal goals. And third, set a clear target for your return on investment, whether that's a steady dividend from a REIT or a higher return from a hands-on flip. All right, here it is, the final cheat sheet. If you prioritize liquidity and a hands-off approach, REITs, the team player, are the clear winner for you. But if you're all about maximum control, using leverage, and getting those amazing tax benefits, then the empire builder path, direct ownership, definitely comes out on top. There's no single right answer here, just the one that fits your goals.
Ultimately, it all just comes back to this one thing. Are you someone who thrives on the hands-on grit of building something yourself, or do you prefer the smooth, passive efficiency of being part of a larger, managed team? Your answer to that question will tell you everything you need to know.
And that leaves us with a final thought to chew on. With the rise of technologies like tokenization, which are really starting to blur the lines between these two paths, maybe the future of real estate isn't about choosing one or the other. Maybe it's about owning a small piece of everything.